The retail market is celebrating the headlines of the Clarity Act passing the Senate Banking Committee, completely blind to the fact that the actual language of this bill contains a hidden institutional trapdoor. You are told this legislation redraws the regulatory map, ends the SEC turf war, and opens a compliant path for Tier 1 capital. That is the marketing pitch. The structural reality is that traditional commercial banks are aggressively lobbying the Senate behind closed doors to weaponize this exact bill against digital liquidity. By the time we finish auditing the mechanics of this market structure shift today, you will see exactly why Washington's version of legal clarity is intentionally designed to freeze the velocity of independent digital assets and protect the legacy correspondent banking monopoly from a structural collapse. To understand the friction, look past the political theater and audit the central mechanism of the Clarity Act, the mature blockchain test. The bill attempts to create a rigid mathematical formula to decide when a token stops being an SEC-regulated investment contract and transforms into a CFTC-regulated digital commodity. The model dictates that if no single entity controls more than 20% of the token supply or outstanding voting power, and if the underlying code is fully open source, the asset transitions into a commodity spot market. Retail is cheering because this explicitly establishes an off-ramp from the SEC enforcement trap. But the institutional engines inside Wall Street clearinghouses do not evaluate decentralization metrics. They evaluate systemic liability. This bill creates a structural paradox where a token can be legally deemed decentralized by a statutory formula while remaining completely unwritten by global custody banks due to lingering operational risk rules. The ultimate deception inside the current Senate draft is the aggressive crackdown on stablecoin mechanics and liquidity rewards. Traditional commercial banking groups have identified a massive existential threat in the cross-border digital economy. If non-bank token issuers can settle transactions globally in seconds while providing yield or transaction-based rewards to entities holding passive digital liquidity, the deposit bases of traditional regional and commercial banks will dry up overnight. To combat this, traditional banking lobbyists are actively engineering amendments to the Clarity Act to completely choke off activity-based rewards and interest equivalent yields on digital assets. They are using federal law not to foster innovation, but to create a compliance wall that strips digital assets of their primary economic utility, ensuring that holding capital inside a legacy banking ledger remains the only compliant option for enterprise cash reserves. This is the hidden divergence driving the low price action that leaves retail investors utterly confused. You are watching a legislative timeline, expecting a bipartisan floor vote to trigger an immediate market pump. Meanwhile, institutional family offices and corporate treasuries are reading the fine print of the compliance mandates. They see a system that is modernizing back office rules such as books and records, customer asset segregation, and qualified custody chains, but simultaneously cutting off the yield incentives that make on-chain liquidity viable. The system is not rejecting the technology, it is rewriting the compliance rules to ensure that when institutional volume finally enters the digital ecosystem, it moves exclusively through tightly regulated banking conduits. The Clarity Act isn't a liberation of the market, it is a calculated blueprint for institutional capture. To understand how the banking system will actually execute the Clarity Act, you have to look at the death of Staff Accounting Bulletin number 121. For years, this specific SEC accounting mandate formed an invisible wall for traditional finance, forcing any insured depository bank that held digital assets for customers to list those assets as a massive liability on their own balance sheets. This made custody prohibitively expensive, effectively locking the world's largest custodian institutions out of the digital ledger. The new draft of the Clarity Act systematically dismantles this restriction, allowing Tier 1 banks to provide digital asset custody without destroying their required regulatory capital ratios. Retail analysts are calling this the ultimate green light for institutional inflows. But what they are completely failing to audit is that removing an accounting restriction does not automatically overwrite a bank's internal risk underwriting protocols. When a global institution like BNY Mellon or State Street evaluates a digital asset under the new Clarity Act framework, the asset is automatically cross-referenced against the Federal Reserve's legacy risk-based examination standards. Under these hidden guidelines, even if a token graduates from an SEC investment contract to a CFTC digital commodity, it must still pass through a rigorous anti-money laundering and Bank Secrecy Act filtration matrix. The custody department of a national bank cannot simply onboard a decentralized token because Congress passed a law. The bank's internal compliance engine must be able to mathematically trace the historical transaction velocity of every single token in its vault to guarantee it has never interacted with a primary money laundering concern. If the underlying public ledger cannot provide that level of programmatic compliance tracking, the bank's internal underwriting board will trigger a permanent operational freeze, regardless of what the CFTC says. This brings us to the hidden battlefield of clearinghouse collateral mechanics. The Clarity Act mandates that centralized crypto exchanges, brokers, and dealers must register with the Commodity Futures Trading Commission to operate legally in the United States. This registration forces these platforms to implement strict customer asset segregation rules, a direct legislative response to prevent another FTX-style collapse. While this provides massive consumer protection, it simultaneously fundamentally alters the liquidity dynamics of the market. When an alternative trading system registers with the CFTC, it enters the traditional clearinghouse ecosystem where every transaction must be backed by qualified collateral. If a clearinghouse views a newly registered digital commodity as highly volatile, it will demand an extreme margin buffer from the brokerages clearing the trades, dramatically increasing the capital costs of moving programmatic volume. The economic friction this creates is why institutional deployment remains stalled. Retail traders assume that clear regulations mean instant, seamless trading volume. In reality, when a digital asset is pulled into a legacy clearinghouse network under CFTC guidelines, the sheer cost of maintaining the required collateral buffers can neutralize the asset's speed and efficiency advantages. It creates a structural paradox where the asset is legally recognized, but operationally restricted by the very clearinghouse mechanics designed to safeguard the market from systemic shock. The large-scale market makers and institutional desks aren't waiting for a bill to become law. They are actively building specialized liquidity routers designed to minimize the collateral drag imposed by these new clearinghouse mandates. The architecture is shifting, but the plumbing remains incredibly restrictive. While retail investors are looking at daily exchange inflows, the real capital shift is happening inside private multifamily offices and sovereign-backed wealth funds. These entities operate on long-term capital preservation timelines, and they are reading the structural changes of the Clarity Act through a completely different lens. For the past 2 years, sophisticated wealth managers have quietly accumulated major digital assets, using off-exchange over-the-counter desks to avoid creating a public price footprint. Their goal is not to trade the short-term regulatory momentum. Instead, they are executing a structural macro hedge against the accelerating decay of the legacy fiat banking system. They view the statutory definitions in this bill as the ultimate bridge that allows them to reclassify their digital positions from highly speculative venture assets into permanent balance sheet grade capital reserves. This institutional accumulation pattern directly mirrors the wealth protection playbooks handled by major family offices. When a high net worth estate manager looks at the macroeconomic horizon, they do not just see inflation, they see systemic counterparty risk inside the commercial banking system itself. Under the new legislative guidelines, once an asset is legally codified as a digital commodity, it can be plugged directly into institutional custody platforms without triggering immediate regulatory audits. This allows large-scale capital allocators to bypass traditional trust companies and establish sovereign control over their liquidity structures. They are constructing highly private, secure digital vaults that can settle multi-million-dollar transactions instantly, completely independent of the standard clearing banks that control the legacy financial architecture. However, the introduction of a strict stablecoin regulatory framework creates a major operational roadblock for these institutional strategies. The current draft of the bill requires stablecoin issuers to back their tokens entirely with high-quality liquid assets like short-term U.S. Treasury bills and physical cash reserves held at insured depository institutions. While this guarantees peg stability, it simultaneously strips the decentralized ecosystem of its native financial velocity. If an asset manager cannot utilize high yield on chain liquidity pools or programmatic reward loops because federal compliance has outlawed those specific structures, the capital efficiency of the entire network drops. Multifamily offices are forced to choose between the safety of a heavily regulated, low yield banking stablecoin or the risk of utilizing unwritten, non compliant liquidity rails outside the United States. This structural friction is exactly why the large scale programmatic volume has not yet hit the public order books. Corporate treasuries and asset managers are not going to risk their core capital in an environment where compliance filters can retroactively freeze or penalize automated transaction flows. They are waiting for the major custody networks and prime brokerages to build fully integrated, compliant clearing systems that can handle tokenized assets under the strict parameters of the new law. The capital is lined up at the gate, but it will not move until the digital pipes are fully reinforced with corporate governance structures. The retail crowd is waiting for an emotional market rally, but the institutional players are waiting for the finalization of the structural plumbing. To truly understand why legal clarity isn't translating to immediate market momentum, we have to look at the unyielding reality of the Bank Secrecy Act. The retail market mistakenly believes that once the Clarity Act establishes a boundary between the SEC and the CFTC, the regulatory battle is won. But the true gatekeeper of institutional liquidity isn't the SEC, it is FinCEN and federal anti-money laundering statutes. Every single Tier 1 financial institution operating within the United States is bound by strict know your customer and suspicious activity reporting mandates. If a digital commodity routes through an automated ledger where individual wallet addresses cannot be permanently tied to verified corporate or individual identities, the legacy banking system treats that entire transaction flow as toxic capital, completely independent of its legal classification. This creates a massive compliance firewall that the current legislative draft fails to solve. The Clarity Act attempts to legitimize the secondary market for digital assets, but it does not alter the underlying criminal compliance codes that govern global clearing banks. When a bank routes sovereign capital through a public blockchain network, its internal compliance engines must perform real-time transaction monitoring to prevent sanctions violations. If an automated liquidity pool contains even a fraction of a percent of unverified, non-compliant capital, the entire pool becomes a structural liability. The risk isn't that the SEC will sue the bank. The risk is that the Department of Justice will file criminal charges for facilitating unhedged, anonymous value transfers, a liability that no bank executive is willing to take onto their balance sheet. Furthermore, the structural friction between federal and state level regulation remains completely unresolved. While the federal bill attempts to create a unified national standard for stablecoin issuers and digital commodity brokers, individual states retain massive authority over corporate banking licenses and consumer protection laws. A prime example is New York's BitLicense framework, which enforces compliance standards that are frequently far more restrictive than the proposed federal guidelines. If a global asset manager wins federal approval to operate a digital liquidity corridor under the new law, but remains locked out of the New York financial ecosystem due to state-level compliance bottlenecks, the economic reach of their network is cut in half. The federal clarity is real, but the state-level plumbing remains completely fragmented. This legal fragmentation is the exact reason why corporate treasuries are moving with extreme caution. They are not waiting for a single legislative victory. They are waiting for the creation of completely permissioned institutional-grade sub-networks. These private, compliant ledger environments are designed to mimic public blockchain architecture while ensuring that every participant, node, and wallet is fully verified under global banking standards. The retail market is waiting for the public, decentralized ledgers to capture global finance, while the institutional world is quietly building an encrypted parallel financial system that uses the technology but discards the permissionless philosophy. The clarity is being used to build the walls of a new digital prison, not to liberate the retail market. The ultimate takeaway from this legislative deep dive is that the global monetary reset is accelerating, but it is moving through a highly coordinated corporate and political channel. Traditional retail investors are waiting for a sudden, chaotic collapse of the old system, expecting a massive capital flight into public, unpermissioned digital assets. But the introduction of the Clarity Act proves that the legacy banking apparatus has no intention of dying. Instead, they are systematically rewriting the rulebooks to absorb the technology of the digital ledger while completely starving out the independent retail participant. They are creating a legal environment where only the largest multi-billion-dollar institutions can afford the immense compliance and clearinghouse costs required to legally move digital assets across international borders. To protect your capital in this evolving architecture, you must immediately abandon the retail speculative mindset. Stop tracking short-term price charts, emotional social media echo chambers, and sensationalized mainstream headlines. The market is not going to experience an instant, unregulated explosion of programmatic volume the moment a bill passes. You must begin auditing the market structure through the exact same lens as a bank risk committee or a multifamily office manager. Your strategic focus must shift toward tracking the physical infrastructure of the network, the custody integrations, the clearinghouse margin metrics, and the real-world deployment of highly compliant institutional stablecoins. You win this game by positioning your capital ahead of the institutional pipes, not by chasing retail momentum. This means you must prioritize holding digital assets that possess undeniable structural utility within the new institutional banking framework. Look for the protocols that are actively being integrated into legacy enterprise ledgers and global clearinghouse networks. The assets that survive and thrive under the parameters of the Clarity Act are not the ones built for speculative anonymity. They are the ones engineered to provide absolute settlement velocity, collateral efficiency, and flawless compliance tracking for global banks and sovereign treasuries. If an asset cannot survive a rigorous Bank Secrecy Act filtration matrix or a Tier 1 custody risk audit, its long-term economic value within the global financial system will inevitably trace straight to zero. The financial architecture of the next century is being codified into law right before our eyes, and the window for front-running the institutional migration is rapidly closing. The clarity Washington is providing is not designed to create a level playing field for the individual investor. It is a calculated mechanism to establish absolute corporate control over the digital economy. If you continue to apply an outdated speculative model to this massive institutional plumbing overhaul, your capital will be systematically trapped on the wrong side of history. Stop watching the news, start auditing the underlying structure, and engineer your financial profile to match the movements of the global elite. The system is resetting, and only the mathematically prepared will survive the transition.